Welcome to the Sojourn Wealth Management Podcast. My name is Corey Akins. I'm joined by my colleagues Jeff Bronner and Andrew Kraft. Today we have an episode covering the cornerstone, one of the cornerstones of financial wellness, and that is life insurance. We're going to talk about what it is, a little bit of its history, how we can use it as a strategy, and some of the unique things that it can do in the overall financial plan. And so really looking forward to it. And hopefully at the end of it, you'll have a better understanding of this really, really important tool. So with that, gentlemen, what is it? What is life insurance?
Yeah, you mentioned the cornerstone of financial wellness. And the reason for that is because life insurance at its core is risk management, risk mitigation. The way it works mechanically is the client, the individual, pays an insurance company to assume that risk. They're outsourcing that risk. That payment is called a premium. And then what they get back for that payment is a death benefit. So in the event when you're going through a financial plan, you want to map out all scenarios. In the event that there's an untimely death, you want to mitigate against that risk and how that affects your heirs and the people that you leave behind. So that in essence, it's outsourcing risk. It's protection against the unexpected, and hopefully, it's not something you have to utilize, but it's there to help protect against that risk.
Awesome, Andrew, you're the resident history buff. Tell me about the history of life insurance, because this is not a new concept, right? Like this is not modern, right? It goes back a ways. Tell me a little bit about that.
Yeah, Jeff, you mentioned the insurance company, but yeah, it wasn't always like that. Originally, groups of people who saw that risk decided to kind of just band together in a club or a group, and everyone kind of pool some resources so that in case someone in the group passed away, that they would have some money to kind of protect or support their loved ones that they left behind. And then I think in the medieval ages, it became a little more formalized with guilds based on a certain type of industry or job. And then I think the first one in America was an organization of Presbyterian pastors or preachers. And then if one of those folks died, then their spouse would get some funds, which ultimately then was taken over by a company called Nationwide. So they traced their roots back pretty far to that type of organization. Company. That's right. Yeah, I think a lot of folks in Knoxville know Nationwide. But that company and many others have since kind of stepped into that gap, and using a lot of actuarial tools can figure out the most inexpensive way to spread that risk. Like you were saying, Jeff, that they're gonna absorb that risk so other people can offload it to the insurance company. Combine a lot of different premiums to then pay out a death benefit to the insured's loved ones.
Yeah. I should say, Andrew's not just a history buff, right? Like you got your degree in history, so
that was my bachelor's. Yes,
credit where credit is.
Yeah. So moving now into modernity, right? You mentioned Nationwide. Talk a little bit, either one of you, about the types of life insurance and those concepts.
So the structure I was talking about a moment ago, you pay the death or you pay the premium, insurance company pays the death benefit. If you add a timeline on that, that's what's called term life insurance. So you agree for 20 years to pay a premium, and during that 20-year period, if you were to pass away, the insurance company agrees to pay a death benefit. That's probably the most basic form of life insurance.
And probably most common too, right?
Probably the most common, that's right. There's a couple different ways you can get a term policy, one of which is in a group setting from an employer. Some of the benefits of that is that the cost of that is spread out across an age band. That could be a benefit, that could be a detriment. Because if you're healthy, you're going to have to pay for all the folks in your age band that are unhealthy in your premium. But if you're unhealthy, hey, you might be getting a deal on life insurance where you might not be able to get that individually. And individually is the other way you can get it. You can just essentially establish a contract with an insurance company and enter into that agreement for 20 years, 25 years, 30 years, whatever it might be.
And that premium doesn't go up
correct
during that time. Whereas I think the employer, typically that will increase over time the longer you're there.
Yeah, that's a good point.
And the reason that you're talking about the health is because when we talk about life insurance, it's always based on health. So that's why the recommendation is typically to get it younger, because you're typically going to be healthier the younger you are. And so if you wait on term insurance, probably going to be more expensive at 35 versus 25 and so forth and so on. But anyways.
And that term policy, I think is one of the most important ones that we do in a conversation. It's not enjoyable, but so vital, because if someone passes away earlier than expected, then it can just derail all sorts of plans.
Right.
And so just kind of a quick kind of glimpse at our process. We don't just take the rule of thumb like, oh, get 5 times your salary, but we want to actually unpack kind of what are the needs. If, you were to pass away, what would you like, your loved one to have? Pay off the house, pay off the college loan, create a fund for college for the kids, or a wedding fund or whatever. And then also a lump sum of money to kind of provide some income for a few years, however many long you may decide. But that all creates this $1 amount that then we discount other sources, retirement plans that you might have, cash in the bank, to end up with that one death benefit. And then covered for a time period, like you said, this term that they want to protect themselves in case someone dies during that time period. So it's an important conversation. It's not a real complicated one, but I think it's really vital to kind of dig down and get the right amount, because having too much insurance usually just costs just not wise. It costs too much.
We don't want you to be overinsured.
Yeah.
Right? Like, insurance poor is how I've kind of heard it, where you've got so much premium going to insurance. We don't want that. But I think something that you're saying, Andrew, is that most everybody will need some form of life insurance at some point, right? Like, and typically it's pretty early, right out of college, because you're really wanting to answer that question, or have the answer to the question, who's going to be burdened financially when you die? And we want to make sure that burden from a financial perspective is eliminated, and that your family can press on as though you were from a financial perspective, still here in some capacity.
Yeah.
And that's kind of ultimately what we're trying to get at. So the other thing too is that you can get a lot of insurance on the term side for a relatively low cost.
Yeah, great point.
When you're 25, I'm talking like $15 a month gets you a lot of life insurance. And so it's not a fun conversation, but a necessary one for sure. What are some other ways, like on the way that we use permanent, or what are some features there?
Yeah. Well, I think one distinguishing feature for permanent is this cash value that builds up. And so, there is, again, like you said, Jeff, the premium and the death benefit, but now there's this third component that the premium is much higher for each dollar of coverage, because part of that goes into a cash value to kind of build up. But the difference there in the name, right? Term is for a time period. Permanent is forever. So
forever.
Right? Yeah. So term is if you die during that time period, and permanent is for when you die. And so those different policies have very different strategies kind of attached to them.
Yeah. And at the base of them both, right, is the death benefit. The permanent carries kind of the cash value. There's also some other features that get added into permanent life insurance a lot of times. So you've got the death benefit, you've got the cash value. What are some of the other features, Jeff?
There are a ton of riders, is the term for it, that you can add to a permanent life insurance policy to provide any sort of element to it that you like. And it goes back to, what is the purpose of life insurance? Why do we use it? We use it for risk management. Some of the common forms of riders that are popular are things like income riders. If you want to turn on an income stream to protect against the loss of a different income stream, maybe part-time employment or something like that in retirement. Waiver of premium, if something were to happen while you're still working in your working years, you can have a rider that essentially you get sick or you get hurt, you can no longer afford. You're evaluating, should I pay my life insurance premium, or should I put food on the table? And you don't want to have that consideration. Waiver of premium waives the premium in that event. And then an increasingly popular one now, and there's many more that we could talk about, but long-term care coverage. As we've developed and medicine has developed and everything, life expectancy has trended upward. And so that has exposed more and more people to what's called longevity risk. And one of the ways you can protect against longevity risk, if you need to go into an assisted living or some sort of in-home nursing care, anything like that, you can get what's called long-term care insurance. And you can add that to your whole life policy so that you essentially have kind of a vehicle that does two things. If you pass away, there's a death benefit. Rather than eating away at your assets to pay for long-term care, you can leverage some of that death benefit while you're still living to pay for that care and to mitigate that risk. So there's a lot of features we could get into with riders and things of that nature, and it really gets into more of the strategies we might talk about in a second. But that's a high-level, quick overview of some of the more popular ones.
Yeah. So you mentioned strategies. What are some of the strategies for people when utilizing life insurance? Like we've been talking about death benefit and tax-free kind of lump sum to our beneficiaries. Somebody might be saying like, well, what are strategies that you use with this? So Andrew, Can you talk a little bit about that?
Yeah. So, we are financial planners and financial advisors. So we are trying to put together a plan in place to help our clients, reach their goals and efficiently reach their goals. And so if there is an issue that's going to derail a plan like long-term care, for example, then it might make sense to add that rider. And so just to unpack that, a little bit more, typically the average stay, I guess, is, 3 years or so. I think it's 2.7, but we'll just call it, 3 years. And so if you are thinking that might be a possibility, which it's a pretty high possibility for most folks, that's going to eat into a lot of your assets. And then if that person who needs that care passes away, the remaining loved one may end up having very little assets. And it used to be, I don't know if it still is, but one of the leading causes of female survivors living below the poverty line is because all their assets were used up. And so having a policy that will provide a tax-free death benefit if you or when you die, but then also if you need this long-term care, you can tap into that policy to pay for that and protect your assets. And so it's just another way. It kind of goes back to managing risk and how we want to manage that risk. And so we put a plan in place, and if it's needed, we figure out, okay, can premiums be provided, by cash flow or through withdrawals from retirement plans, or can you self-insure? Because I think early on in the episode, Jeff, you mentioned outsourcing or off,
right?
Putting that on the company,
right?
And that's usually the best way. Sometimes it's not necessary, but that's kind of how we go through that planning process.
And I've heard it said that nothing drains an estate quicker than long-term care. Like that need just drains.
The cost is increasing.
Expensive.
Absolutely.
Yeah, it starts expensive and it's going up.
Yeah, and it outpaces inflation significantly from the cost of living in an assisted living facility or having in-home care. Those costs just rise exponentially each year. Yeah. What are some other ways? So like we've talked about the insurance side, protecting assets, adding those riders there. There's also another way that people use it, and we would say it's kind of like a supplemental retirement plan. Can one of you speak to that?
Yeah. So the idea there is that you have a limit on what you can save for retirement in either an individual retirement account or your employer plan. And so you've kind of hit that limit as a high income earner. That's kind of the key. It's the supplemental retirement plan, I think, is sold to a lot of people, but it really probably should only be considered by high income earners typically. So they're saving for retirement, but that amount and then Social Security is not nearly going to replace the income that they had. And so they can create a life insurance policy that has the cash value that's really high, almost equal to the death benefit, and a death benefit as low as possible. And so this is, yes, managing the risk of not having enough money in retirement to fund your goals. It's not necessarily the death benefit risk, but it is, kind of managing that risk of not reaching your goals.
And many of the retirement plans that you're talking about have restrictions on when you can access them, right? So you typically are not going to be able to access your 401k. The earliest you would be able to do so is at 55. IRAs, it's 59 and a half. And so this would provide, for high income earners who are maxing out those kind of workplace plans, IRAs, things like that. If they say they want to retire at 52, this is a great way that they can do that to where you put enough assets into the policy to then kind of bridge the gap or have tax-free income. I mean, there's all sorts of benefits.
Which is often common. You have a high-income earner working, tail off, making a lot of money, and they are wanting to retire earlier.
Right. So. Exactly.
One strategy that's the inverse scenario that we're talking about is someone who isn't a high earner, someone who maybe wants to leave a sizable legacy behind for their beneficiaries, their heirs, their children, whoever it might be. Maybe it's even a charity or something like that they care about. Buying life insurance, paying the premium, and letting the death benefit be what you leave behind. Creating an estate, so to speak, through the life insurance vehicle. Maybe you're not able to save save the assets that you like to leave behind, so you're kind of bridging that gap. You're getting to where you want to be as far as the legacy planning goes, and you're using life insurance as that bridge.
Yeah, developing that legacy. That's a great point. One other one I'll mention is just disinheriting Uncle Sam.
Yeah. Ooh, now you have my attention.
So, and just really quickly, a retirement plan is inherited, let's say, by your kids, and they will pay taxes on that over the 10-year kind of inheritance time period. So if you change the beneficiary to a charity or church, 501c3 organization from your retirement plan, they'll now get those assets out of your IRA or 401k or whatever, get those tax-free, and then you leave your life insurance policy to your children, for example. They'll inherit that tax-free, and Uncle Sam is left holding an empty bag.
Tax-free and in a lump sum. I mean, that's
right. Good point.
Very unique solution. To my knowledge, there's not another solution out there that does that, where you receive the benefit all at once and Uncle Sam does not pull out a piece, right?
Right.
And so that's important. As far as the disinheriting, you're kind of talking about using the IRAs, those going to charities, and then the life insurance policy going to the beneficiaries. As far as kind of the mechanics of that, I've also seen people use like IRAs, so maybe they aren't charitably inclined, but they use kind of the RMDs to pay premiums on life insurance. So they're kind of taking the tax hit, and then their beneficiaries then get the life insurance policy tax free that way.
Yeah, that's kind of combining, Jeff, your estate creation and then the tax elimination, because they're just like, hey, the children, again, for example, will pay some taxes, so we're going to give them the life insurance plus some tax free, and that's a great point.
Yeah, absolutely. So, any other thoughts on the topic, guys, before we kind of close it out?
I think just focusing on the risk management to start is the most important thing.
Right.
And I think it's important to sit down with an advisor and talk about that, and then kind of figure out what are some other risks or goals that life insurance can meet.
Goals and what risks impair them.
Absolutely.
And I think the biggest thing is just have that conversation. Like you're saying, Andrew, sit down with somebody, evaluate this. And it's an emotional conversation. It's a difficult conversation. But it's really necessary in order to make sure that the ones you care about are taken care of in the event that you pass away.
I'll give you a back end story just very briefly. This was probably 10 years ago. I was at an insurance company, and a guy had emailed me. He was 34 years old. And he said, "Hey, Corey, I was wondering if I could get some more life insurance." And I was like, "Well, yeah, let's try." Turns out he was terminally ill and ended up passing away about 6 months later. His wife, we were able to stroke a check to his wife, tax-free, lump sum. And I can't tell you you said it a second ago, Jeff, the emotion there, right? That burden of financial hardship was eliminated. And so that's why it's important. And we want to make sure that those who lean on us are taken care of.
Yeah. And if I can just add one more kind of little
Yeah, go
story.
ahead.
Again, this was, 22 or so years ago. A good friend of mine, 2 young daughters, and he was the breadwinner. And so we got him a term policy. And like a year or two later, he was diagnosed with cancer that, praise the Lord, he lived and is healthy, but he was uninsurable.
Amen. Yeah.
But he had that coverage for that time in case he didn't. So it's such a great way to kind of, again, manage that risk.
Yeah. And that's why we say it's a cornerstone of the plan. So guys, I thank y'all for your time and look forward to doing it again soon.
Appreciate
Absolutely.
it.
Thank you for listening to this episode of the Sojourn Wealth Management Podcast. This is a friendly reminder that all content in this podcast is intended for educational purposes alone. Nothing in this episode should be treated as tax, legal, or investment advice. We encourage you to consult your financial professional for any of those needs. Securities offered through Kestra Investment Services, LLC, Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC, Kestra AS, an affiliate of Kestra IS. Kestra IS or Kestra AS are not affiliated with Sojourn Wealth Management.